Hi guys, Jared Johnson with Day Traders FX. In the previous video, we talked a little bit about the difference of being an option buyer versus being an option seller, being long a call option or short a call option, long a put option or short a put option. In this video, I want to talk a little bit about some strategies that we can look at, do, follow with this long and short. Again, you can make a lot of different kind of food with a few different kinds of ingredients, and that is exactly option trading right there. We can be buying and selling calls and buying and selling puts and make a whole massive number of option strategies out of that. We just need to know how to kind of organize those and put those together. So here are a couple of examples of option trading strategies that will come from mixing these buys and sells. Now, just once again, I want to review. If you're an option buyer, you have unlimited profit potential, limited risk. The market really needs to perform. It really needs to behave for you. Time is not on your side. Option seller, we have limited profit, and limited risk, but the market doesn't need to move big for us. Time is on our side. Those are the big differences, right? That's why we have calls and puts. You can be long a call or long a put and short a call and short a put. They mean very different things. Once again, being an option buyer or being long an option is very much akin to a home run in baseball. Being short an option is very much analogous to just a base hit, getting to first base. It's easier to do, it's less rewarding, so to speak, but it's much more easily repeated and consistently done. So let's talk a little bit about some of these strategies here and how we're going to make some of this work. Let's go over here to the example of what we can do with being short options and long options and so on. So here are a couple of strategies that we could create out of being long and short the option, and I'll try to explain a little bit on how these work. Okay, with option strategies, there's really a lot of them. There's a lot. I'm going to talk a little bit about the ones that I use the most and go into more detail on those. Covered calls, right? This is being short a call option and owning stock. Credit spread, this is just two call options or two put options. We're long and short a call or we're long and short a put. That's a credit spread. Naked calls and puts, I can just be short a put or short a call. We'll talk about that. Here's a lot of other ones that I don't use so much. Iron condors, calendar spreads, straddles, strangles, and the list kind of goes on and on. There's a lot more strategies, but I would say that I probably use these guys the most right here. Covered calls, credit spreads, naked calls, and puts. And let's talk a little bit about how those work and what those consist of. So let's talk first off about covered calls and why and how this is a good strategy. And then we will dive into a couple of these other ones. Okay, so what is a covered call? A covered call is exactly this right here. A covered call is, number one, I own the stock. Number two, I sell a option, call option, on the shares I own. So here's how this works. If I have 100 shares of Southwest Airlines and I bought that 100 shares at, say, $45, right? Let's put a straight line in there so it doesn't look like a crazy one here. So I own 100 shares right here. Here's my 100 shares of love. I own 100 shares at $45. 45 bucks. So with this 100 shares, I can sell a call option on that. This is one of my favorite strategies. I love covered calls because it's so great and wonderful and fantastic. Now, if I own 100 shares at $45, obviously any time I get out of Southwest Airlines above $45, I'm making some money. If I get out at $45.01, I made 1 cent a share, right? If I get out at $46, I've made $100 on that trade. I get out at $47, I've made $200, right? Because that's now $2 above the price. If I bought at 45 and I get out at 47, that's $2 higher than I bought in, and I have 100 shares. I make 200 bucks. Now, where the long and short option situation comes in is if I own 100 shares at $45, I have the option to sell a call. Let's just say, to keep the math real good and simple, let's say I sell a $46 call, $46 strike price, and this is a call option. And this would constitute a, there we go, this is going to constitute a covered call. I own 100 shares at $45. I sell the $46 strike price call option. I'm selling it. I'm short the call option, but I own the shares of stock. This is a covered call. So I own the shares of stock. Now, here's how this is going to play out. Let's say that my expiration is, we'll just say here. On this call option, we're going to say 2-week expiration, just for the sake of it, 2-week expiration. So I bought these shares here. I'm selling a 2-week expiration, $46 strike price. Now what happens is, in 2 weeks, if Southwest Airlines is above $46, the broker, I'm going to lose the stock, right? The broker will take the stock from me at $46. But that's okay. I bought the stock at $45. So I will get $100 in stock profit. This is, again, at expiration if the stock price is anywhere above $46, $46.01 and higher. The downside is the stock could be at $100 in 2 weeks, and I still have to sell it at $46 if I hold it till expiration. So the benefit to this is, if a stock is moving slowly, what might happen is when I sell this $46 strike, maybe I make $100, right? Selling this $46 strike. So if the stock ends up above $46, I make $100 on the stock because I bought it at $45 and I'm getting out at $46. Plus, I was able to sell this option, this $46 option, for $100. So I get $100 in option profit and $100 in stock profit. I'm out with $200. If, on the other hand, in 2 weeks, the stock is below $46, I still keep the $100 from option profit and I keep my stock. So I got paid $100, I don't have to sell my stock, and I can sell another call option on that stock. So it's a great way to, I would say that covered call trading is probably the lowest risk stock and option type trading that you can do. It's the lowest risk. Now, it ties up the most money and it probably pays the least, but it's a very low risk, very steady, good strategy, and I love it. So this is what a covered call is. I'm short a call option, but I own the stock. So I really have no risk. If I let this run, if I let this $46 strike price run till expiration regardless, I'm going to keep the $100. So again, let's just say I was paid $100. So $100 to sell that $46 strike price. If I let that run till expiration, either way I keep the $100. The difference is, if the stock price is above my $46 strike at expiration, I have to sell my stock at $46. If the stock price is below my $46 strike price at expiration, I still keep the $100 and I keep the stock. That's all a covered call is. Now, you might be asking, well, can I sell a $49 strike price? Can I sell a $55 strike price? Yes, you can. You can also sell a strike price lower than where you own the stock. Wouldn't super recommend it, but it's something you can do. And there's reasons that you can do that. But the difference is, if you sell, let's say we own the stock at $45 and I sell a $46 strike, I'm going to make more money than if I sell a $48 strike price, right? Here's a little example. This would be selling a call option. Here's the stock trading at $47.59. So that is at the money right there. If I own the stock at $47.50 and I sell a $50 strike price, if I get taken out at $50, I'm going to make the difference from $47.50 to $50, which is $2.50 a share, or $250 for every 100 shares I own. Plus, I'm going to make about $180, $185 on the option. So if I own at $47.50 and I get taken out at $50, I'm going to keep all my $180 of call option profit that I made from selling that call option, and I'm also going to keep the $250, which is the difference from $47.50 to $50. But you can see the higher I go, if I go to $52.50, what happens? I'm making less money. Here I can sell the option for 182. Up here I can only sell it for about 115. But I'm making a lot more money on the stock side of things. I'm making another $2.50 per share. So it far makes up on the stock profit. I just make less money on the option profit. And the further away I go from the stock price, the less money that option pays. So this is our example of a call option in conjunction with owning stock. And again, this is called a covered call. And covered calls are wonderful. We love covered calls. It's really hard to lose money trading covered calls. I love covered calls. Now, if I were to just sell a $46 strike price and I did not own shares, that would be a naked call. And we're going to talk a little bit more about what that is and what that means. But that would be a naked call option, and that would be pretty bad risk. In this case right here, if I did not own the shares, I had no shares of stock, and I just sold a $46 call option. If at expiration the stock price is below 46 bucks, I would keep my $100. If at expiration the stock price was above $46, I would get assigned the stock. The broker would say you have to buy the stock. I'd be assigned the stock short at $46, which would be terrible. And along the way, if this stock ran up a whole bunch, I could lose a lot of money on that call option because I have no stock backing it up. So that's all I'm going to say about that. But needless to say, we're never, ever, ever going to sell a naked call option on its own. Just don't ever do it. If you think about it, if you think it might sound like a good idea, don't do it. Because it's pretty unlimited risk. And there are very, very, very few. In fact, there's one example that I can think of, and it's a long explanation, where that's a good idea. Otherwise, don't do it. So we're never going to sell a call option on its own. We'll sell a call option in conjunction with owning stock, and that's just fine, and that's a good thing to do. So that is what a covered call is. That's a covered call. I hope that makes sense. I hope that's helpful. This is a strategy that I personally use and that we use in the trade group extensively. It's a great strategy, and it's very good, consistent, easy money to make. Hopefully that's helpful. Thanks, everybody. Good luck, and happy trading.